thing to highlight, which is catching all of the headlines, is the headline number was down. Yes, down more than expected as well. We have some surprise inflation data that's really moving the markets here this week. I'm Brandon Steele, financial advisor with Mainsail Financial Group here in Bellevue, and our goal is to leave you feeling more empowered every week and share with you some of the news stories and the headlines that are really shaping the markets, hopefully weeding out some of the noise along the way. And again, this week, we are very much focused on the inflation data that's come out this week, which is really starting to shape the markets and really starting to tell a bit of a story in terms of how this could translate for what the Fed's watching ahead. So on Tuesday, we had consumer price index data come out, CPI data, and basically the big thing to highlight, which is catching all of the headlines, is the headline number was down. Yes, down more than expected as well. So headline number for CPI was down 0.4%. Now, keep in mind, although this is catching all the headlines, that this is the headline number as well. And what I mean by that is that this does not include food and energy, which are very volatile. And of course, energy is extremely volatile right now with everything going on in Iran. So this is important to watch, but we'll touch on the core number here in a minute, which might tell a little bit better story. However, this puts the year-over-year inflation number at 3.5%, again, on the headline number. All right, second thing to mention on Tuesday was, of course, we also got the core CPI information, which is, again, stripping out food and energy. That was also better than expected. This puts, it was actually flat. Core CPI was flat for the month, and it actually puts the year over year at 2.6%. So both numbers actually were better or lower than expected. And both bring, as you might imagine, the year-over-year numbers down as well. So this started conversations around what the Fed may do. Before I touch on that, I also want to highlight that yesterday on Wednesday, we also had PPI numbers come out, Producer Price Index. And the headline was also down here, down 0.3%. And core was up less than expected, but it was up in the core PPI number, up 0.2%. All right. However, again, the biggest thing is how this is shaping the market. So basically, all of this is to say that inflation came down more than expected. And it's also to say that the markets are looking at what the Fed may be thinking based on this inflation data. So overall, markets have liked it so far, and basically seeing a huge shift in the Fed funds expectations ahead now. So that is really what's driving a lot of the markets here this week. With lower inflation, basically the market is suggesting that the Fed is now very unlikely to change rates, or to raise rates, I should say more specifically, which is a huge shift, because from Warsh coming in, we went from probably no hikes on rates to markets were thinking there was going to be a hike on rates, or betting that was the more likely scenario, to now back to a scenario where the markets are suggesting it's not as likely that we see a hike here this year. So big shifts. Fed Chair Warsh kind of shared his perspective yesterday as well, but basically the market is really looking at suggesting, I should say, that they don't think that the Fed will be hiking this year at this point, or it's less likely anyways at this point. What I will also share is how this translates to the bond markets, because the 10-year has dropped significantly over the past couple of days as a result of these numbers. Keep in mind that this is based on the Fed interest rate decisions and path, but it's also based on inflation, right? If you're buying a 10-year bond, the idea is you want to make sure you're factoring in inflation over that 10 years, because if you're getting 2% and inflation is 3%, well, you're going backwards. And so inflation has a big impact on how treasuries and bond yields get priced over time in the market anyway. And that's ultimately what we've seen over the last couple of days. Today, we also had retail sales come out. Retail sales were up 0.2%, basically right in line with expectations. And before we touch briefly on the question of the week, it's going to be more of a kind of a tease of what's to come, but be sure to tune in next week. We have a lot of housing data to cover next Thursday. The big item we'll touch on this week is basically around earnings, because we are getting into earnings season. We just started kicking off majority of earnings season here this week. And the thing I wanted to cover here is to watch very closely is the earnings expectations going into this quarter. the expectations are extremely high, and I don't think it's likely we see a huge shift from that. So whether it hits the numbers, exceeds the numbers, slightly below the numbers, regardless, basically the takeaway is that we're seeing really strong earnings out of companies here in the US, and certainly big expectations for what that should deliver here for this quarter. So that is a big story we're watching over the next few weeks, is how these earnings expectations translate to reality. But basically going into earnings season here, it looks like we should have a very strong quarter for earnings, and that could shape kind of the next leg of the markets here, depending on what we find out in the coming weeks. So be sure to tune in next week. We'll continue to keep you updated on the earnings season as it progresses as well. But again, the big story this week is the inflation data and how that's driving the markets here moving forward. Again, next week we'll cover earnings. We'll also cover some housing data. So in the meantime, have a great upcoming weekend, but we will see you next Thursday at 3.